Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading.
This is a quote from Soros, and let me just read it. Expectations about exchange rates play the same role in currency markets as expectations about stock prices do in the stock market. They constitute the paramount consideration for those motivated by total return. Again, that idea of expectations about future exchange rates. It is the driver. It is the driver of short-term speculative capital, which is the ballpark in which we're talking about here. Soros goes on and makes the point that ultimately we can spend all day long trying to forecast real-world events, but it may not matter. It says, ultimately, one, we can't forecast real-world events, so that's the problem. But number two, what the goal should be here is to just determine what the consensus expectation is about real-world events and just simply focus on that and see how reality plays out against those expectations. Because surprise is the stuff that moves markets. So here's a guy that's, probably one of the smartest investors in the world. And this is the way he looks at currency exchange rates and how to evaluate them. Needless to say, Soros does a lot of his own global macro stuff and factors in a lot of things. But in the end, he realizes that expectations in the changes in expectations against reality is where the meat is. And that's why he tends to develop scenarios and tends to make bets based on scenarios of how expectations will be fooled in the future, clearly understanding that he can't forecast real-world events. Okay, and this is kind of the meat of the presentation here, and I'll spend some time on this. In terms of currency valuation, currencies, just to step back just a second, ultimately currency prices are driven purely by supply and demand. It's really the only true free market in the world at the moment. Governments would love to set currency rates. They can't. The market is just too big. It truly is driven by supply and demand or capital flow. And in terms of the reliable fundamental drivers that we do know, we really know one, interest rates is what I said is the only thing we do know, but we also know on top of that is what the current inflation rates are, or at least we have an idea or a thumbnail idea of the valuation of inflation rates across countries. Those are the two things we do know. The other real driver in here in terms of fundamental drivers is economic growth, and that's the stuff we don't know. Again, we do all this analysis to try and figure that out, and this is the stuff that drives long-term confidence. If you look at number one there, interest rates and inflation rates, that's the stuff that really drives the short-term hot money flow into currencies. This is that big pool of speculative capital that's running around out there looking for the highest yield, highest return, and moving from country to country very short-term. Interest rates are the driver here. The long-term stuff, long-term economic growth, is that long-term money flow or long-term portfolio flow that tends to flow into a currency. And the nasty part about this is, or the positive part about this is, interest rates and economic growth tend to work together. There tends to be very much a feedback loop. As economic growth heats up, interest rates tend to go higher. As interest rates tend to go higher, or at least the expectations of them going higher, it tends to create more capital flow, and they tend to self-reinforce again here. So you can see again that self-reinforcing type of circle as interest rates tend to be supported by economic growth and vice versa. Now, the idea of current yield differentials is really the key. For example, let's use the Australian dollar versus US dollar right now. Current yield in the US dollar on Australian dollar on a short-term basis using the latest numbers from Economist magazine, we're looking at about 3.35% three-month yield. The US three-month yield is 0.21%. So guess who wins on the hot money scale in terms of yield differential if you look at nominal rates? Right now, Australian dollar by a large margin. Look at the 10-year yields, and the 10-year yields tend to be a more value differential. because 10-year yields is that bond stuff, that stuff that brings in more portfolio flows and that type of thing, where people find longer-term opportunities, and it tends to bring in some of the larger deep money into your sovereign bond markets. So the 10-year yield is important to watch. And what's very important too is because these are going to tend to be longer-term investments. You want to, when you look at the 10-year yield, you definitely want to factor in what's called the real rate as opposed to the nominal rate. The real rate is simply the nominal rate minus the inflation rate. And there's those inflation rate differentials. Obviously, if you have a country like Zimbabwe that has interest rates at 200%, but their inflation rate is 1,000%, it doesn't matter. So this is where you get into the interest rate, inflation rate differentials. Obviously, across the major currency pairs, there isn't that often that big a difference in terms of inflations, but it can be significant if you look at the 10-year yields. So you always want to, I think, look at your short-term yield and your longer-term yield here. And let me just give you an example. Everybody thinks the U.S. isn't really in the tank, but if you look at the U.S. 10-year yield, it's 3.45%. And again, look at Australian dollar 10-year yield, it's 5.37%. So you're looking at almost a 2% differential there on the nominal 10-year yield. But if you factor in inflation rates, the latest U.S. inflation was negative 2.1%. The real yield on U.S. 10 years is 5.5%. The real yield in Australia is 3.87% because you have positive inflation in Australia. So when you step back and look at that in terms of a valuation basis, presently, buying U.S. 10 years have better long-term real value than Australia, even though, again, we think short-term hot money. And that's another reason why a lot of people, I think, have been surprised at the performance of the U.S. bond market. If you step back and look at the real yield, the portfolio flows into the U.S. bond market has still been very, very strong, despite all the concerns of deficit financing and federal budget deficits and the like. And part of that is it's a very attractive real yield given the negative CPI in the U.S. So on a short-term basis, the U.S., you can say, really looks ugly, but on a longer-term basis, and again, that portfolio flow, you got to remember, is a powerful support for the U.S. dollar. And maybe that's part of the reasons it hasn't fallen off the cliff in here, because we know the sentiment is very, very bad in the U.S. dollar, and we constantly hear analysts saying that the relative yield is so low in the U.S. dollar. Yes, on the short end it is, but on the longer end, the U.S. dollar is the highest real yield of any of the major currencies in the market. So please keep that into consideration when you think of these choices. Again, does this mean that the U.S. dollar is all of a sudden going to turn and rebound? No, but it does give you an understanding that maybe you're not going to see a run on the dollar if this type of valuation for the portfolio flow into U.S. Treasuries is that strong. So again, it's just something to keep in mind. As I said, there's very few real indicators that you can hang your hat on. There's a lot of confusion out there. At the moment, we've seen some fairly tight correlations in a lot of different asset classes, stocks, commodities, oil, gold, those types of things are very tightly correlated to the U.S. dollar in this cycle. But over time, we haven't seen that before. And the question is, how long will this stuff last? And in fact, we're starting to see some of it break down recently, these correlations. So we can't really count on that as a reliable indicator. And the other problem with using correlations is, number one, who leads and who follows. Especially when it comes in, I'll show you some of the interest rate rules in a second, the currency versus interest rate rules, and I think something that you can take away, if nothing else, from this. Often the currencies, one of the problems with currencies is when we sit there and we tend to try and make all these forecasts on interest rates, the reality is currencies often lead interest rates, and that's just a fact. And that's another problem getting to this wound up in, hey, what are interest rates going to do? What are interest rates going to do? Can we forecast interest rates? We can't forecast interest rates. Sometimes we can get lucky, but we can't. And the reality is, if we can forecast interest rates, we better be careful, because again, we don't always know when the currency is leading or when the currency is lagging. And I'll show you some rules that'll help keep that in mind and give you some idea, or at least a higher probability of success when judging changes in interest rates to determine who's leading and who's following.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.